In the last decade or so, there's been an explosion of research in behavioral finance, and it's all really designed to answer one question, which is, why do people do what they do? And one of the more interesting experiments was by Chabris and Simons, where they essentially created a video. And in the video, they filmed two basketball teams passing the ball back and forth. And they gave their viewers one task, which was to count the number of times the team in white passed the ball. Well, in the middle of the segment, they have a gorilla walk through the screen.
Guy in a gorilla, so yeah.
A guy in a gorilla to walk through the screen, and he stops, looks at the camera, beats his chest, and walks off. And believe it or not, over 50% of the viewers failed to see the gorilla. And what that tells you is that people have selective attention. By focusing on that one act of counting the number of times the team passes the ball, they actually exclude other important variables that are going on in a very small context. And so they're using, and this is all within a simple example of using the visual side of their brain, and they neglect to see the gorilla.
Yeah. In fact, you might have heard that Chabris reran that same test, but in front of a group of people like his colleagues, and he did it at PopTech in 2010. And of course, everybody in the audience knows to expect the gorilla, and so they counted the passes, they did the gorilla, and then at the end he said, oh, and who noticed the fact that one of the guys in the black shirt on the black team left the scene? And of course, these people who are trained to look for it missed it as well.
Well, that's what's so cool about these experiments, is because it shows that whether you're a behavioral economist or you are an intelligent person or a wealthy person or an old person or a young person, it happens to all of us.
Yep.
And so I think it's an important lesson to take away.
Totally agree.
You know, it never ceases to amaze me that when you ask two people to look at one stock, you get radically different opinions. Sure. Well, one's a buy, one's a sell. And you know, it's tempting to just sort of shrug your shoulders and walk away from that. But in another sense, when you start looking into the question why do different people make different choices, ultimately it leads you all the way back to the brain and the human brain and the way it functions and operates, both from a cognitive standpoint as well as from a psychological standpoint. And so once you begin to understand the workings of the brain, you can actually draw a line all the way through to those decisions that people make. And you know, starting with the brain, you know, you have all the different properties that the brain's capable of, and I know you've done a lot of work in that area, which I hope we can get to. But also, it gets into the nature of beliefs and belief formation and how you develop the core beliefs starting from a very early age in your life. And as you grow older, certain of those core beliefs become very important to you, and others beliefs are tangential, and they're tactical beliefs that you cling to at points in time or for other reasons that might influence your behavior. Yeah. And so in combination with your life experience, these things form your worldview. And that worldview becomes a lens through which you look at things like stocks and bonds and whatever you might be investing in. And so you can't ever truly escape that. And so I think it's really important that you understand that decision string from where the brain is all the way through to how you make choices.
Yeah, totally agree.
Whereas the selective attention test is purely visual, investing is really conceptual. And so the number of places where your brain can limit the way you can observe reality and truth grows exponentially relative to that. So it highlights the need for being aware and cognizant and having a framework to deal with it.
Totally agree. And you know what, even at this late stage, the frontiers of behavioral finance, I think a lot of people still don't understand the rudiments of behavioral finance. And you know, for example, like I remember behavioral finance with a little mnemonic device, which I call LOCMAR, which is brain locks, so it mars your performance. So like LOCMAR. And of course there's loss aversion, which says that we feel pain much more acutely when we lose money than when we gain money. And there's a stock market aphorism, which we're all familiar with, of course, which is that stocks on their way up climb a wall of worry. And then of course there's overconfidence, which of course none of us suffer from, right? And it says basically that we're going to be overconfident in our assessment of the world, and yet we're going to underestimate our weaknesses. And then, of course, there's confirmation bias, which, as I know you like to quote Abraham Maslow, and he has a phrase which is the man with the hammer syndrome, which is, of course, the guy who has the hammer, he sees the entire world like nails. So in investment management, it's especially deadly because what it means is if you have a thesis about a particular stock or a bond, or you have a macro view of things, any new data that comes into you, it's either going to confirm your assessment, or you're going to reject it and rationalize any negative information that doesn't confirm your bias. So you get these wacky biases. And of course, there's mental accounting, which, by the way, I think most people misunderstand. Mental accounting basically says that you should see the world holistically, but instead you see it at a micro level, right? You see it in a microcosm in a totally siloed way. An example from my own career is you get a cash redemption for your portfolio, and rather than selling an underperforming security out of the long-term capital portion of your portfolio, you sell a better performing security out of your short-term capital because you've artificially accounted for these two parts of the portfolio. You should see it holistically. And of course, there's anchoring, which of course is that if you're given a new situation that you're unfamiliar with, you're most likely going to reference something similar that you are familiar with. So if you're from Boston and somebody says, hey, what's the population of Mumbai? You're going to assess that relative to Boston.
Or if you buy a stock at 50 and it goes down to 40, you're still anchored into that 50 price as your benchmark to beat, right?
Totally. The sunk cost bias, exactly.
Yeah.
And then the last one, representativeness, basically is like the classic stereotype. So you're at a sell-side research conference, which of course can be a dull, dismal affair sometimes. You're hearing a steel company. You're hearing your like fifth steel company in a row, and you can't hear the uniqueness and the unique qualities of this steel company and the unique time and place they find themselves in. Instead, all you do is relate it to all the other steel companies. So I think a lot of people still haven't even like absorbed these lessons.
Before we get into the details of how to apply behavioral finance concepts, maybe it's a good idea for us to talk about some of the ways that we ourselves went wrong and made mistakes back in our own careers. So one for me was H&R Block. So I remember taking interest in the company in the early 2000s. They had just brought on a new CEO, Mark Ernst, who was engaged in a new strategy to diversify the company into other financial services, including banking, investment brokerage, whatnot. And that violated a rule that I had. I never liked when companies diversified for diversification's sake. I always wanted them to continue investing in that core business that had the strong returns. But Warren Buffett had been a major share owner in the company, and he came out with some flattering praise about the CEO and the opportunities with H&R Block. And even though I did my due diligence, I think somewhere in there it shaped my thinking about the company. And ultimately, the arc of the performance of the business over time demonstrated that it really didn't make a whole lot of sense to combine the banking and the investment brokerage with their tax preparation business.
So it was Buffett that you were hearing in the Ernst and the whatever.
Yeah, authority misinfluence right there.
Yeah, got it. Yeah, so for my own career, I remember right before I got promoted from research analyst to portfolio manager, I was just waiting for approval from the board of directors. And I wanted to have a big impact on the fund as soon as I got promoted. And there was a company I'd been tracking for some time and had done a lot of work on called International Rectifier. And I'd done a comprehensive valuation model as a part of all the other fundamental work I'd done. And I got a fair value of about $45 a share. And lo and behold, International Rectifier was trading at about $45 a share. So there's no value there, right? But when I got promoted, because I wanted to have an impact on the fund, I started stretching my model a little bit, making slightly more aggressive assumptions, and I could find ways to sort of up the fair value price to about $60 a share. And of course, what happened is International Rectifier promptly traded down to about 28. So this is a classic example of a couple things: overconfidence, for example, and representative bias, et cetera, et cetera. And so the lesson is, if you want to have a big impact on your fund, let it be a positive impact, not a negative one. So much as I love behavioral finance, right, and I think it's an important advance over like the homo economicus, which is the pure rational thing, I've always had kind of a bit of unease about it. And the unease is, I think it's really difficult to implement in practice. And I think that the behavioral economists and behavioral finance folks that have carefully mapped out this space haven't done us any favors. I think they've essentially given us a diagnosis, but not much of a prescription, quite honestly.
Yeah, when I looked into it, I always had more questions than answers. And so, dealing with the frustrations of what the status quo was in terms of the research and how to apply it to actually individual stocks, I always struggled. And so, what I think we're going to talk about today is the result of a lot of hard-fought, hard-won wisdom that that you and I have used in various ways in our portfolio management over time.
Yeah, totally agree. So we just said, behavioral finance is a diagnosis without a prescription. And essentially they're saying you're doomed to repeat these mistakes over and over again. And as I know you like to say, it's as if saying you're going to touch that hot coffee pot over and over and over again and burn your hand no matter how many times you've burned it, which to me just doesn't make any sense.
Yeah, it doesn't square with our experience. And I think as humans, we all know in our own lives and in the lives of our family and friends that we make mistakes, but we learn from them and we get better and we build skills over time. So that's where I think there's a departure from the conventional wisdom.
Yeah, and in fact, like if you look at like Dick Thaler, Cass Sunstein, Dan Ariely, Daniel Kahneman, some of the big luminaries in this space, it's not that what they've done is wrong. It's just that we're right at the frontier. We're right at the stage where we need prescription for some of these things. And I think what they've offered us is solutions that deal with the symptoms as opposed to the root causes, which are behavioral, let's be honest. And in fact, I remember Daniel Kahneman at our 2012 annual conference in Chicago said something to the effect of when he was asked, what do you do to overcome these biases? In other words, great doctor, what's the prescription? He said, there's very little you can do. I've been in this space for over 40 years and I still make these mistakes. And knowing the biases is not the recipe to overcoming them.
One of the fascinating things about the state of the art in behavioral finance right now is that many of the behaviorists themselves fall prey to their own behavioral biases, and you can see it in their work.
Yeah.
And sometimes they talk about, say, whether or not people who are taking drug A versus drug B, and maybe drug B has a superior efficacy profile, but the people who don't switch, they automatically assume that they should have switched and that they are subscribing to some behavioral bias.
Right, somehow they're just not smart or
But
something.
that's just not always the case, because there's a lot of variables that individual people, human beings, have to actually deal with. Like, you don't want to be the one person that takes drug B and dies, and you don't want to say, on your deathbed that the one thing you're more grateful for than anything was that it killed me, but others got to have enjoyed lower blood sugar. So people make those choices and trade-offs, and sometimes I think they fall outside the scope of where the behaviorists look.
Yeah.
Another example is Michael Mauboussin recently put out a piece where he talks about whether or not people are making good decisions in terms of taking early retirement. So the normal retirement age is 65. If you take it early, you get less money from the government, and if you take it late, you get more money from the government. And that appears to be the only variable that they look at. But the only thing you can say conclusively is that people value their time and freedom more than they value that incremental money. And so, even though I respect Michael Mauboussin and his work and does a lot of great things, in this one particular case, it's very clear that he's also demonstrating a behavioral bias.
I think it bears mentioning that we have to look at the backgrounds of some of these guys too. They're experts in their fields. So for example, if you look at Dick Thaler and Cass Sunstein, Dick Thaler, and they frequently write together. Dick Thaler, he's an economist by practice. Cass Sunstein is a legal scholar, right? And Dan Ariely is a psychologist and a behavioral economics guy. Daniel Kahneman himself is a psychologist by training, and he, of course, along with Amos Tversky, his research partner, mapped out the entirety of the space. And so their solutions tend to look like just like their disciplines, right? So Thaler is an economist, so guess what? He thinks if you manipulate incentives, you have nudge economics and you can help overcome some of these biases. Again, I'd say that they're dealing with the symptoms. You've got Ariely, and Ariely is a psychologist, so he tends to think of how do we manipulate the mind and kind of, not trick people, but get people to do the right thing. And I think probably the person who's come closest to what I think is the right answer and where the real prescriptions lie is Kahneman himself, though I still think he misses. And in his very famous book, Thinking, Fast and Slow, he identifies two types of thinking. He's got system one thinking, which he says is where most people are thinking most of the time, which is instinctual. It's the flight or fight. People are making snap decisions about things. And he says it's centered in the brain's amygdala. Then you've got system two thinking, which by contrast is what most of us think of as intelligence, right? So here it's, the thinking is slow, it's deliberate, and it's logical, et cetera. He says it's centered on the prefrontal cortex. And there's support of that from what community? Neuroscience. And I think neuroscience is where the answers lie, but what's interesting is if you actually look at the neuroscience research itself, it's much more comprehensive and much more interesting, and they actually have solutions for how you overcome the biases. So one important point is, neuroscientists who help you overcome bias, they have identified that decision-making is distributed through the entire brain. It's not just isolated to the amygdala and prefrontal cortex. It's distributed throughout, and different regions have different functions at different times, though they're kind of oriented towards certain things. But most importantly, for us as investors, neuroscience, beyond a shadow of doubt, has proven neuroplasticity. And so what neuroplasticity says is, hey, if I lift a weight with my arm, I'm going to build up a bigger bicep. Neuroplasticity says, hey, if I discipline my mind and if I think in a particular way, guess what? My brain's going to change to adapt. I think that's where we have to look if we're going to have any hope of a prescription.
Many times we treat investing like a closed system, but in fact it's an open, dynamic system where new variables are constantly being added and old ones fading away or being dropped. And you've got to deal with this dynamic dimension in the marketplace. And you still can't escape the beliefs that are driving some of the choices that you actually make. So the beliefs might actually shape what type of information you seek, or what you think needs to be validated and what doesn't, who you trust and who you don't. All these things are determined at a subconscious level. And so people have to wrestle with that. And if you don't explicitly take steps to measure that and understand what you're doing inside, you're subscribing to these things. And so whether it's your DCF model, every model breaks down at some point. So if you're using a DCF model, or if you're using the risk-free rate, if you're using VAR, whatever it is, there are limitations to all those things. And so it's really important that you understand what beliefs and expectations you have that are embedded in your usage of these things.
So if in fact you agree that neuroscience has some answers and some prescriptions, you'd want to look at neuroscience and what are they talking about in that space. And it turns out there are two skills that you need to develop if you want to overcome your behavioral biases. And the first one is called metacognition. And essentially that's awareness of awareness itself. So you're sitting there, you're hearing me talk, and you're assessing what I'm saying, right? You're evaluating it, you're reflecting on it, and you're thinking about it. So we all have this ability naturally, but most of us are not engaging that awareness with any level of control. So not coincidentally, that's the second thing that has to be developed, is you have to have what's called top-down control. And it turns out the left insular cortex is the part of the brain where you can do that. And the top-down control is super interesting because it's like it has kind of a temporal dimension to it. So you put a pause between stimulus and response, right? So by doing that, you're able to gain control over what you think, and so you can control what your awareness is. So there's a real simple formula if you're going to overcome behavioral biases, and that is awareness plus control equals the ability to do that.
So how do you put that into practice, like in a practical example?
Well, so like a real practical example is, in my international rectifier example, if I had been aware and had control of my thoughts, I would have recognized, oh my God, like all of your decisions have absolutely nothing to do with the fundamentals of the company. You know, like you're making, the awareness would have said, oh, wait a second, this has to do with you trying to become a portfolio manager, you know, transitioning from research analyst, as opposed to any fundamental reason. And the control would have been, you stop yourself, right? Like you got the awareness and so you stop yourself. So you bring up a great point though. I mean, I think the primary job of a research analyst or portfolio manager is to bring your mind as closely in accord with reality as is possible. You want to see the world for what it is. You don't want it to be distorted with biases and prejudices and so on and so forth. There are a couple of like prescriptions that you can actually, that I believe really work and that I utilize in my own career. The first is an opinion diary. And an opinion diary came from, early on in my career, I recognized that I made a lot of decisions each and every single day that never rose to the level of a buy or sell decision in the portfolio. But I wanted to get better. I wanted to be a better thinker. I wanted to see the world and discount it properly. And so I recognized, wow, I need to start recording many of my decisions, many more of my decisions than just the, hey, we should buy this security. So as I was evaluating the news, I recognized, wow, I'm reflecting on that news and how it impacts my portfolio. I'm making, or I'm formulating like a belief system about the state of the world and the macroeconomy and little stuff. And so I started documenting all this stuff, and then I would reflect back on it at least once a quarter. And if there was a security that was involved, I would put the security price at the time I had the thought. And what this did is it gave me awareness, right? Very tangible awareness, you know, per that formula I just mentioned. So I've got living proof in writing of this awareness function. And then the other thing it did is, because I put a pause between stimulus, the news flow, or you know, some sort of real world phenomenon, and decision, response, I was able to engage that top-down control. So an opinion diary is a great way of overcoming behavioral finances biases.
Yeah, I couldn't agree more. I think having that opinion diary or some mechanism for keeping track of exactly why you're making the choices that you're making becomes an objective source for you to look back on over time to verify, were you right, or are you creating false justification to fit the new reality that you face some point down the road?
Yeah, totally agree. So the other technology I wanted to talk about, and I would put a good portion of my success as a portfolio manager in my career on meditation's back. Meditation was a difference maker. And I'm not the only one who thinks so either. Ray Dalio of Bridgewater Associates is a big meditator, as is Paul Tudor Jones II of Tudor Capital. And it turns out, by the way, that there are meditations that specifically address these things that I highlighted you need to develop. So, for example, what most of us think of as mindfulness meditation, which is getting a lot of notoriety in the press, mindfulness is developing that awareness function that I said is absolutely necessary to overcome bias. But there are other types of meditation as well, including focused awareness meditations, which give you that great top-down control. So you may be asking, what's the science? Okay, great. I want to make sure this is not a woo-woo technology and you're going to ask me to sing Kumbaya, right? You asked for practical applications. So I won't make you sing Kumbaya. So it turns out there's lots of science that's examined the ability of meditation to overcome bias. So with your indulgence, let me share with you a couple of the studies.
Please do.
Yeah, so the first one, first two studies actually I want to talk about are very similar. They looked at, the experiments were conducted almost exactly the same way, but they looked at slightly different regions of the brain. So the first experiment, or the experiments, they showed high arousal images to people, and these were terrible images, like of surgeries, mid-surgery, or like war wounds, designed to elicit a response, most likely revulsion in most people. And it turns out that people who scored normally on their mindfulness scale, or low on their mindfulness scale, had that classic response. Oh my goodness, I don't want to see those images. But people who scored high on mindfulness, they didn't have that same experience. And when the neuroscientists looked at these people's minds when they conducted functional magnetic resonance imaging tests, what they found is, one of the studies found that the prefrontal cortex was not only more activated, but larger in those who score high in mindfulness. The other study, specifically, same study, but they looked at a different region of the brain, showed that the amygdala was smaller and less activated. So that is a direct evidentiary, that's direct evidence of the prescription that Daniel Kahneman would have wanted.
So meditation equals using your brain better.
Yeah, exactly. It's exactly right. Great point. Yeah. So, like another study that directly tested one of the assumptions, or one of the classic behavioral finance tests, looked at the ultimatum game. And the ultimatum game is two participants. So I say I'm gifted $100. They get random, and you're the other participant. I don't get to keep my $100 or a portion of that $100 unless you agree to my bid, right? So I may offer you $50. You may accept $50 in return. Most likely you're going to accept it if I say, hey, of my 100, you'll get 50. So we both walk away better. Now, what happens at the 70-30 level is you start to dip below, with most people, below the fairness level. Like they have an innate sense of my fairness has been violated, and less than half of people accept 70-30 offers, but not for meditators. So in extreme offers of 90-10, I get $90, you get $10, or I get $95, you get $5, turns out that meditators, in that first example, they will accept 61% of those kinds of offers. And for the extreme one, 95-5, 54% will accept those offers. Now, logically, rationally, you ought to accept a penny, even if I get $99.99, because you're a penny better off than you were before.
Right.
So this is another example of a study that has directly tested behavioral finance in one of their classic games and shown that meditators do, in fact, think differently. The fourth study, real briefly, they tested really hardwired biases, racism and ageism. And it turns out that meditators are, to a much greater degree, and with statistical significance, able to overcome the racism and ageism biases. Now, I don't know about you, but I'd say that those are much more difficult biases to overcome than something like mental accounting, for example. So there's hope. And then the last study, and I'm not going to torture you. You can tell I've had too much coffee, right? So the last study also looked at behavioral economics result. So here we had study participants were shown abstract images, and I know you're an artist, right? So imagine yourself in a fMRI machine and you're being shown these abstract images, and I say to you, hey, Ron, you're going to be given $30, and the ABC company is sponsoring your effort today. And then it turns out there's another company involved in this study, XYZ company, but they didn't sponsor you. If I show you these abstract art images, guess what the result is? you favor, show a strong favoritism in liking the art of the company that sponsored you on that research. Now, unbeknownst to the study subjects, the researchers actually showed the same artworks where the sponsoring company was. They later showed them to the subjects again, but the non-sponsoring company sponsored them. And what they demonstrated was that it was solely the sponsoring company that resulted in you favoring the images. Clearly a bias. But after 8 weeks of mindfulness meditation, that result completely disappeared. So the point in all this is that opinion diaries and meditation are great prescriptions that can allow you to overcome some of these biases. We're now dealing with the root cause. We're educating the mind. We're not just putting Band-Aids on some of these wounds.
So essentially, through the meditation, you're able to focus on yourself and where you are manifesting biases.
Yeah, it's a great way to put it, or per what I said earlier, right? I said, you know, your job is to see reality for what it is, not what you'd prefer it to be. And meditation is a way of putting on hold that entire thing. You start to see things, and you get to control what you think. It's not that your mental models are wrong, but they're not right in every circumstance and context.
Right, great point. So as you think about active investment management, there's essentially 4 possible outcomes. You are right and the market's right. You are right and the market's wrong. You are wrong and the market's right. Or you are wrong and the market's wrong.
Sure.
And obviously in 2 of those quadrants, you're congruent with the market. And so it's not possible to add alpha if you're congruent with the market. The only way possible to add alpha is if you're right and the market's wrong. And yet few people take the time to focus on what it is that the market thinks and what it is that I think. And so it's really important that you actually focus in on what it is that the market thinks and try to identify any biases that might be at work in the market as reflected by the market price. And in that way, you can better understand yourself and whatever biases that you might be using.
That's a super useful framework. Yeah, I mean, I think if you're going to add alpha, you have to, by definition, be doing something that nobody else is.
Absolutely.
Yeah.
And so, so I think it's really important that people have that in mind. And so if you are going to be focused on adding alpha, if you're in active management, it's essential to draw that difference between your perceptions and the markets.
Yeah.
One of the things that's fascinating to me about talking with you about behavioral finance is that you and I approach it from very, very different perspectives, but we often come to the same conclusions. Yeah. And the way that I've approached it was to come up with something that I call the 5-point analysis. And the key feature of the 5-point analysis is, of course, fundamental analysis. So you got to actually understand the business, the industry, the accounting, the competitive dynamics management, and all that stuff. But so there's no substitute for doing that hard work. And so everything that we advocate here and that I advocate is certainly a supplement to good fundamental analysis. So I just want to make sure that we're clear on that point. But beyond that, in order to deal properly with the identification of behavioral bias, you've got to complete the analysis. And it's not just fundamental. You've got to include policy considerations. You've got to think about whether it's monetary policy, regulation at the individual micro company level, or whether or not it's coming from some other source. You've got to make sure that you understand the policy impact that's having an effect on whether it's pricing or supply or demand or whatever it might be affecting that particular company. So you can't simply exclude that and focus on company reports and information exclusively. And then beyond policy, you've got to also understand history. So within history, you can look at the history of the company, the history of the market and whatnot, but really what I'm talking about is the rhythms of history. So you're looking for an understanding of what caused companies to fail in the past and what caused them to succeed. And so if you look back through time, you might look back to the era of the late 1920s when they invented something called shoestring mortgages, which was essentially a parallel to subprime loans that we saw blow up during the financial crisis. Or whether it's when the oil patch went south in the mid-'80s and the energy companies started going south, and hence the banks in Texas started going south a year later. And so you had a year window to really examine what was going on in the oil patch and how that might impact the banking system.
I loved how you put the rhythms of history. That's a great term.
Yeah.
I'll remember that forever.
Yeah. So that piece, I think, is critical to inform what you're looking at. And again, you're looking for mental models that you can apply in an appropriate situation as you move forward. Beyond that, you've also got to account for agency costs. What are the incentive structures at work in your the target company, the company you're considering investing in, the issuer, whether it's a government or an agency or whatever. You got to look at what is the incentives for the people involved. You know, they're lining their own pockets, or are they looking out for shareholders and so forth. And oftentimes on an a priori basis, it usually follows pretty closely with the incentive structure that's in place.
Totally agree.
And then once you've exhausted all of those things, I think then you bring in the behavioral analysis. And then you start looking at things like confirmation bias. You start looking for gradual misperception, mean by repetition, you know, all the different elements that might go into shaping the judgment, not only for yourself, but also for market participants as reflected in market prices. And you can observe that by the fluctuation in market prices relative to behavioral events that transpire, or any of these events that transpire, whatever category you're in within the 5-point analysis.
That's a super useful framework, yeah. Yeah, I think you cover a lot of the bases there, and it's scalable from macro down to micro.
Absolutely, so each of those have that dimension of macro and micro.
Yeah, cool.
Yep.
Well, so that 5-point framework I think is super useful. I would put you in the hot seat the way you did me. Give me an example, Remkes.
Absolutely. So the first one I think that really works within this framework is an investment I made in Wind River Systems back in the early 2000s. Wind River is to embedded systems what Microsoft is to desktop computing. Right. And so they control the operating system. And so if you go back a little bit further, back into the late 90s, of course there was a tech bubble, but why was there a tech bubble? So you had two major policy events occur that contributed to the tech bubble. One of them was the Reverse Plaza Accord in 1995 that drove up the value of the dollar and interest rates. And then secondly, the Fed was printing a lot of money during the late 90s as it got closer to the Y2K phenomenon.
They do that?
I've heard, yeah. So those two things, those two policy events actually contributed strongly to the overvaluations and high valuations that you saw in the tech space. On a behavioral basis, there was a behavioral event which is not only growth investors, but a lot of other types of investors became growth investors when they were attracted by that. They were attracted by the eye-popping returns, by the phenomenal short-term performance, and just the era that was created during that environment. And that represents a behavioral bias that people were attracted to growth for growth's sake, without necessarily taking into consideration all the other variables that you have of being an owner in a business. So then, once the bubble popped, you had an unwinding of all that. So you had an unwinding of the behavioral bias. So all the people that were growth investors, or part-time growth investors, they all stepped out, and then the stock began to fall. And it was also shortly before that Warren Buffett, of all people, came out and said that tech stocks were worth zero. So the appropriate value for a tech stock, I think is the quote, was zero.
I remember that, yeah.
And so legion of value investors, and I was one, legion of value investors walked away from tech stocks. So nobody would even look at a tech stock because Buffett didn't give it his imprimatur. Right. And so you had a lot of people stepping back, and hence you had this open space of opportunity for what turned out to be probably about 2 years to make a substantial investment. And so when I started looking into that, I was very conscious that there was nobody there to buy a stock like that. And for me as a value investor, and particularly as a Buffett-style value investor, I was very aware of making that decision. And for me, it felt like stepping out on a cliff's edge and stepping off and just walking on air. And even though I was grounded in my research, I definitely had that fear and discomfort, which in retrospect is probably a good thing.
Yeah, we all do, yeah.
But on a fundamental basis, the price of the stock began to get so low that it was almost less than the net cash value of the business. So they could have folded up the business, paid off every liability, and you would have gotten your money back. And so what that means is if management is not being frivolous with that cash, that you're essentially getting a premier business for free. And so that's when I was able to step in, and that's what gave me the comfort to step in and step apart from what the crowd was doing at that time.
Nice job.
Thank you, sir. So another example I have is an investment that I made in Baxter International. So Baxter is a major blood products manufacturer and medical device company. And it's a really simple story, ultimately, because there was a policy event. So the FDA stepped into the blood plasma market and shut down one of Baxter's key competitors. And this phenomenon happens from time to time in both pharmaceutical and biologics and blood products businesses. So whenever there's a manufacturing irregularity, the FDA shuts them down for a period of time until they can demonstrate to the FDA that any safety violations have been rectified. And so we knew that happened, and that was a situation that was ultimately temporary in nature, even though you had no idea how long that might last. But what happened was the market demonstrated something that's very common is a short-term bias, short-termism.
Sure.
And they rewarded Baxter stock handsomely because as Baxter started filling in on the shortage in the marketplace because the competitor being shut down, they had more sales, they had more earnings, and they even made some capital investments to grow the capacity in that unit. And so as that improved, the market was rewarding the stock. But for anyone who's willing to take a step back and say on a long-term horizon, if I own the business for 30 years, would I look back on this event as a key pivotal moment in that corporate history? No, he wouldn't. And not only that, but with the capital investment they made, that was certainly at risk once that competitor came back online. And that's exactly what happened. So the following 18 months, the FDA gave approval to that company to come back online. And as it happens during that window, 2 foreign competitors came into the market.
Of course, yeah.
And so they jumped into the market. And so they went from a period of having 2 competitors to only 1 competitor, and then ultimately to 4 competitors. And then the market went haywire. But on a fundamental basis, at that time, they were launching a new product called Advate, which had a superior risk profile in the blood plasma market. And so because of that, we had confidence that they would at least maintain, if not improve, their market share in the blood plasma segment. And so because of that coalescing of all those forces, we were able to see very clearly that there was an opportunity there for a long-term investor, someone who was willing to look over the horizon of the short-term marketplace.
Sure.
And so we were able to clearly define that there was a short-term phenomenon in the market and a long-term investor would succeed. And that's in fact what happened. So it turned out to be a really good investment for us. The last example I want to talk about is nothing that had anything to do with me, but it's long-term capital management. And some of you may know what transpired there, but it's a really fascinating story. And the more you get into it, the more fascinating it becomes. The 10 or 12 key principles in the company were probably a collection of the smartest people in corporate history. They had 2 Nobel Prize winners. They had people that were famed with their expertise on Wall Street. And they had lots of experience and a wonderful track record that went back decades. And so all these people had a lot to offer. And it becomes a really interesting story because they failed because they believed something that was false. And ultimately, they believed in their models. And their models told them that they would make money in certain situations. And as it happens, they were completely wrong. And so one of the things, their VAR model looked at a trailing 2-year window on the marketplace. And had they looked at a longer expansive history and incorporated that, number one, they would have identified that a large adverse event was certainly much more plausible than they were expecting.
Right, yeah.
And so then, in addition to that, they were making a lot of directional bets. And even in the arbitrage portfolio, there are reasons why the arbitrage might work against you. So you might think an arbitrage portfolio, you have limited risk, but if both positions move in the opposite direction you're expecting, bad things happen. Of course, they levered it up 130 to 1.
Of course.
And they left themselves absolutely no room for error. And so these principals had invested all of their own life savings into the strategy.
Oops.
And when the company imploded, their net worth also imploded. And so to observe that, I think the best quote that I've seen on that was from Warren Buffett, who said, "To take money you have and need to get money you don't have and don't need is just foolish."
Yeah.
And that's exactly what the principals did. And it's fascinating to see that come from people who are so otherwise intelligent.
Yeah, and to wrap things up, if you circle back to what we were talking about earlier, that one example has so many examples of the classic behavioral biases that we talked about, from overconfidence to mental accounting to anchoring to certain time periods as valid, et cetera, et cetera. I mean, it's a disaster.
Yeah, absolutely. And there's many lessons to be learned, and I would urge anyone to take a closer look at long-term capital management.
Totally agree. So I think all of this is super hopeful, and I think we find ourselves totally at the frontier here. And the frontier is, wow, what's the prescription? Behavioral finance thus far has been a great diagnosis, not much of a prescription. And I think the lesson here, or the message here that both of us agree about, is that we're not constrained by our biology to the extent that the behavioralists would have us believe. If anything, we're liberated by our minds. Maybe constrained by biology, but liberated by our minds.
Yeah, and the key message is be careful what you pay attention to. Because if you limit yourself to one thing, just like in the gorilla experiment, you miss out on so many other things.
Yeah, and then the other thing, because we find ourselves here in the frontiers, I think it behooves us in old school CFA fashion, early 60s, when portfolio managers and research analysts would share, war stories and they would learn lessons from them. I think that's exactly where we find ourselves. I think there are lots of PMs and research analysts out there who probably have developed their own technologies for overcoming these biases. It'd be great to hear from them.
So the advice ultimately is to take a holistic approach, right?
Take a holistic approach, get your mind in accord with reality, and you're going to do much better than those who don't.
Agreed. Amen, brother.